Most people believe their money is safest inside a bank, protected by law and promises. They imagine vaults, insurance, regulations, and institutions designed to guard their savings. But the uncomfortable truth is this: once money enters a bank, ownership quietly changes. What you call a deposit is legally something very different from what you think. When you deposit money, the bank does not store it for you like a coat in a locker. It becomes the bank's asset, and you become an unsecured creditor in their balance sheet. The numbers on your screen are not cash held in your name, waiting patiently in reserve. They are a promise the bank makes to repay you, or conditions you rarely read. This distinction sounds technical, boring, almost harmless until stress enters the system. Because in a crisis, contracts matter more than comfort, and law matters more than trust. And banking law across much of the modern world is built for survival of institutions first. Depositors are protected only so long as protection remains convenient for the system. To understand this, we need to leave marketing language and enter legal reality. Banks operate on fractional reserves, meaning most deposited money is immediately reused. Your deposit is lent out, invested, leveraged, and multiplied across the financial system. The bank keeps only a fraction on hand, betting that not everyone asks simultaneously. This works beautifully during calm periods, when confidence is high and withdrawals are predictable. But banking history is a record of what happens when confidence disappears overnight. When withdrawals accelerate, banks do not magically summon stored cash from vaults. They turn to emergency tools written into law, regulation, and crisis frameworks. And this is where the misunderstanding becomes dangerous, because most people think the worst outcome is a bank running out of money. In reality, the worst outcome is something far more subtle and legally sanctioned. It's when access is restricted, balances are restructured, and losses are reassigned. After the 2008 financial crisis, governments quietly rewrote the rules of failure. They wanted to avoid taxpayer bailouts that rescued banks using public anger as fuel. So they introduced a new mechanism designed to stabilize failing institutions internally. This mechanism is called a bail-in, and it changes everything for depositors. Under bail-in rules, a failing bank is recapitalized using its own liabilities. That includes shareholders first, bondholders next, and in extreme cases, depositors. Deposits above insured thresholds can be converted into equity or written down, not confiscated illegally but transformed legally overnight, by design. This is not theory, speculation, or conspiracy. It has already happened, repeatedly, across different countries and systems. In Cyprus in 2013, depositors woke up to frozen accounts and forced conversions. Balances above insured limits were seized and turned into bank shares without consent. People protested outside locked branches, holding signs that read, "Our money is gone," but legally, the government argued nothing was stolen. The banks survived, the system stabilized, and depositors paid the price quietly. That moment changed global banking forever, even if most people never noticed. After Cyprus, bail-in frameworks spread rapidly across Europe and beyond. The European Union formalized them under the Bank Recovery and Resolution Directive. The United States implemented similar logic under Dodd-Frank's Resolution Authority. The message was clear: future crises would be resolved internally, not politically. Deposit insurance still exists, but it is not infinite nor unconditional. Coverage caps apply, payout timelines can stretch, and access can be delayed. Insurance protects against insolvency, not against temporary freezes or restructuring events. And in systemic crises, timelines matter as much as guarantees. Even without formal bail-ins, banks have other legal tools to restrict access: withdrawal limits, transfer delays, technical outages, and compliance reviews. These measures are framed as safety precautions, but their impact is identical. Your money exists, but you cannot reach it when you need it most. Recent history offers sobering reminders. In Lebanon, banks imposed informal capital controls without passing new laws. Depositors were limited to small withdrawals while currency value collapsed. Savings evaporated not through theft, but through enforced immobility. In Greece, ATM withdrawals were capped during the debt crisis. In India, demonetization rendered cash temporarily unusable overnight. In China, bank protests erupted after rural depositors lost access for months. In each case, legality followed necessity, not the other way around. The pattern is consistent and uncomfortable. In extreme conditions, banks do not ask for permission to protect themselves. They act first, explain later, and rely on law to catch up behind them. Depositors discover that access is a privilege, not an absolute right. This is not because bankers are uniquely evil or malicious. It is because the modern banking system is designed to prioritize continuity. A frozen account angers individuals. A collapsed bank destabilizes nations. Policy always chooses the latter risk to avoid the former. Understanding this doesn't require panic, but it demands clarity. Money in a bank is safe until it isn't needed most. It functions perfectly during normal times, and dangerously during abnormal ones. And history teaches that abnormal times arrive more often than expected. The real danger is not knowing this distinction exists at all. Believing deposits are personal property rather than unsecured claims. Trusting systems without understanding their failure modes. And assuming yesterday's stability guarantees tomorrow's access. Because when banks lock doors, they do not break the law, they follow it. To understand who gets hit first, you have to read a bank's balance sheet upside down. Assets live on one side, liabilities on the other, and deposits sit as promises owed. When losses punch holes through assets, liabilities must absorb the shock mathematically. Law decides the order, not fairness, emotion, or how long someone saved. Shareholders are first in line, because equity exists to absorb losses by definition. Bondholders come next, because yield always implied risk, even when marketed as stability. Depositors arrive later, but only after thresholds, insurance caps, and political patience expire. This hierarchy is written clearly, even if marketing language tries to soften it. Insured deposits are treated differently, but insured does not mean instantly accessible. Payouts require verification, processing, and time, sometimes weeks during broader stress. Meanwhile, bills, payrolls, and emergencies do not pause for regulators or administrators. Liquidity matters more than guarantees when systems freeze without warning. Above insurance limits, deposits lose their special status entirely during resolution. They become eligible for conversion, reduction, or restructuring under bail-in authority. This is framed as fairness, spreading pain among stakeholders rather than taxpayers alone. But fairness in law does not feel fair when savings disappear on paper overnight. Banks and regulators justify bail-ins as stability tools, not confiscation mechanisms. They argue losses must land somewhere and deposits represent the largest available pool. The alternative is collapse, contagion, and panic spreading across interconnected institutions. From their perspective, individual access becomes secondary to systemic survival. This logic explains why bail-ins are rarely announced in advance. Public warning would accelerate withdrawals, turning stress into immediate catastrophe. So silence becomes policy, and surprise becomes a feature rather than a failure. Confidence is preserved until the moment it is no longer necessary. Once doors close, narratives shift rapidly from reassurance to inevitability. Officials speak of temporary measures, extraordinary circumstances, and restoring stability. Legal language replaces emotional appeals, and courts defer to emergency authority. By the time explanations arrive, outcomes are already locked in place. The modern system also blurs lines between banks, markets, and governments. Deposits fund loans, loans fund securities, securities collateralize derivatives. A problem in one corner ripples instantly through every connected balance sheet. This is why resolution frameworks favor speed over consultation or consent. Digital banking accelerates this dynamic further, shrinking reaction windows dramatically. Withdrawals happen in seconds. Rumors travel faster than press releases. Banks now face runs without lines, triggered by notifications and social feeds. In response, Authorities favor preemptive controls rather than reactive apologies. Account freezes no longer require insolvency to be justified legally. Compliance reviews, anti-money laundering checks, sanctions screening, and cybersecurity events. Each provides lawful grounds to restrict access without declaring formal failure. Together, they normalize interruption as a standard risk of digital finance. This is where the illusion of ownership quietly dissolves. You may see a balance, but control belongs to layered systems above you. Banks, regulators, payment rails, and correspondent institutions each hold veto power. Access depends on alignment across all of them, not on your intentions. History shows people adapt only after experiencing restriction firsthand. Before crises, warnings sound abstract, even paranoid. Afterward, they sound obvious, even embarrassing. Every generation learns the same lesson, then forgets it slowly. Protection does not mean abandoning banks entirely or hiding cash dramatically. It means understanding concentration risk and dependency on single points of failure. It means knowing which assets are claims, which are custody, and which are final. And it means planning for access, not just nominal value. Diversification across institutions, jurisdictions, and asset types reduces exposure. So does maintaining liquidity outside systems prone to synchronized restrictions. None of these strategies eliminate risk entirely. They simply shift odds away from catastrophic single-event loss. The most important protection is psychological, not financial. Knowing freezes are possible prevents panic when they occur. Preparation preserves optionality when others are forced into bad decisions. Ignorance turns inconvenience into ruin faster than numbers ever could. Banks will continue advertising safety, simplicity, and seamless access. They are not lying. They are selling normal conditions as universal truths. Crises live in the exceptions, not the averages. And law is written for exceptions, not marketing slogans. The uncomfortable reality is this: modern money is conditional. It works flawlessly until conditions change, then obeys different rules entirely. Understanding those rules does not make you cynical. It makes you realistic in a system built on confidence. Because when banks lock the doors, they do not ask permission. They follow the framework. And the framework was never written for you. If this changed how you see money, subscribe. History doesn't shout warnings. It repeats them quietly.